All right, let's take a strategic pulse check on the Indian gold market. We're in January 2026, and the precious metal is at a really critical point. It's defined by these insane all-time highs, a pivotal union budget that's just days away, and this massive global shift away from the US dollar. So let's break down what's really driving this market.
Okay, let's start with what's happening right now. Gold hasn't just been climbing, it's absolutely shattered some major psychological barriers. On the MCX, we've seen prices blow past the 1,61,000 rupee level, and it's currently trading at 1,61,950 per 10 grams. This lines up with global spot prices crossing that $5,000 per ounce mark. I mean, these aren't just numbers, they really represent a whole new world for this asset.
And this brings us to the core conflict, the real puzzle we're trying to solve here. For the average retail buyer, someone shopping for a wedding, this price just causes sticker shock. It feels totally unsustainable, right? Like a bubble that's just about to pop. But the institutional data, what central banks and the big funds are actually doing, tells a completely different story. This is a story of a huge gap between fearful retail sentiment and some seriously aggressive institutional action.
So, to really understand what the big players are thinking, we need to break down the structural bull case, and we're going to start with its biggest global driver. Look, this isn't about some short-term momentum play. It's about a tectonic shift in the very foundation of the global financial system.
This slide really illustrates a critical concept that we call the Great Rotation. For decades, the US dollar has been the undisputed king of central bank reserves. Well, that's changing. Central banks, and the Reserve Bank of India is a major player here, are actively swapping their holdings of US treasuries for physical gold bullion. And the sheer scale of the strategy is just massive. 880.2 tons. That's the RBI's current gold holding, a record high. To put that into perspective for you, gold now makes up nearly 17% of India's total forex reserves. Just 2 years ago, back in 2024, that number was closer to 10%. So you see, this is a deliberate multi-year strategy to reduce their exposure to the US dollar.
Building on that, the second major driver is less about that strategic rotation and more about, well, global anxiety. There is a fear premium being priced into gold right now, and believe me, it's growing.
This map just highlights the reality of the unstable world we live in today. The threat of escalating trade wars, with potential tariffs of 100% on China and 200% on the EU. It creates immense uncertainty. In an environment like this, gold stops being just a commodity. It becomes the preferred safety asset, the ultimate hedge against all this geopolitical chaos.
Okay, so let's bring this all back home to the Indian consumer. How are these record-high prices affecting domestic demand, especially with the wedding season in full swing? Well, the dynamics are shifting in a big way.
So here, you can see the two faces of Indian gold demand. On one hand, physical jewelry purchases, they're facing some serious volume issues. Buyers are choosing lighter-weight designs or even 18-karat alternatives. But on the other hand, investment demand is just exploding. We're seeing record peaks in things like gold ETFs, which you can trade on exchanges just like stocks, and a massive surge in digital gold flows. So, what's the key takeaway here? The volume is moving from adornment to asset allocation.
Okay, so we've laid out a powerful bull case, but a complete analysis means you have to look at the other side of the trade. There are significant headwinds that could absolutely challenge this rally. It's crucial we understand these downside risks.
So, what could derail this train? First up, a breakthrough in US-China trade talks. A resolution would calm the markets and definitely reduce gold's safe haven appeal. Second, a stronger US dollar would make gold more expensive in other currencies. And third, a domestic risk. The government could hike import duties to control the current account deficit. If prices stay above that 1.6 lakh mark for too long, we could see a severe drop in retail consumption.
And this brings both the bull and bear cases into sharp focus on one single near-term event that every single trader in the country is watching: the upcoming union budget announcement.
The market is essentially pricing in one of two outcomes for February 1st. Scenario A is a cut in customs duty from 6% to 4%, which is kind of what the industry is expecting right now. This would cause an immediate 2 to 3% price cool-off, and that would create a buy-the-dip signal for a lot of people. Then there's Scenario B, the status quo, where duties stay the same. This would act as a powerful signal of support at the 1,58,000 rupee level and would likely push prices even higher.
Now,
Zooming out from the immediate budget drama, the long-term structural view gives us a pretty clear path forward. The global consensus from major firms like JP Morgan and Goldman Sachs sees gold hitting $5,100 an ounce by the end of the year. For us, that translates to a target of about 1.9 to 2 lakh rupees. The steps on this road are clear. De-dollarization and central bank buying are really forming the foundation.
This slide really sums up the core tension in the market right now. You've got the bull case, which is driven by global instability and this systemic pivot away from the dollar, pushing for a surge toward that 2 lakh rupee mark. And then you have the bear case, defined by the potential for a trade breakthrough or a policy change, which could stall the rally and trigger a drop in consumption. It's a real tug-of-war.
So, with all these forces at play, what are the key takeaways? What are the critical data points you should be monitoring over the next 12 months to really navigate this market?
It really comes down to these 3 signals. First, RBI accumulation. Keep an eye on the central bank's data. Are they continuing to buy above the current 880.2 tons? Second, geopolitical risk. Monitor any official tariff announcements from the US, China, or the EU. And third, Fed policy. Watch for any signals of rate cuts if global growth starts to slow down. These 3 dials will tell you the direction of the trend.
And that brings us to our final thought. In an environment like this one, high volatility can be unsettling, for sure, but the structural data suggests it should probably be viewed as an opportunity, not a threat. The underlying message here is that gold has become the new global currency, as the dollar's dominance faces its toughest test in a generation.